I'm Bambi Francisco for Vader TV, the network for innovation and innovators, and I'm speaking with Robert Simon. He founded Ariva Partners, which is a new venture fund, actually with a new model for early stage venture investing. Robert, thanks for joining us.
Thank you. Nice to see you, Bambi.
Nice to see you as well. So this is a new fund for you, and you're focusing on the very early stages of a company's life cycle.
Absolutely.
This is where you see what the opportunities
We've
are.
been in the venture business now probably 15 years, and we've looked at the statistics and anecdotal evidence. And if you sort of make money in the venture business in two areas, one is the later stage, and the other is in the early stage. The later stage funds are typically larger, they invest larger dollar amounts, and they make typically 2x the investment and return of the portfolio. The earlier stage side, it's much riskier, but you are rewarded for that with typically 5x returns on the portfolio. So.
Right.
Consistent with our background of the founding partners of Ariva Partners, we focused on the early side. That's consistent with our background, and we think that's the best opportunity.
Well, before we get into the background, we talked a little bit about the fact that this is really underserved in terms of the dollars that are going, or at least a percentage of a venture portfolio going toward these smaller seed rounds.
Indeed. If you look at the history of the venture business, and let's say it got started in the 60s and 70s, early on, a lot of the dollars were allocated to the really early stage opportunities, and then they followed on with investments. Today, with the maturity of the venture business, you have a larger capital pool, and it's naturally gravitated towards later stage as the funds get larger. Mm-hmm. So, for example, a fund typical size now is anywhere between $400 and $600 million. Mm-hmm. So if you assume a typical number of companies in the portfolio, around 20 to 30, you get a larger average size investment, maybe $20 or $30 million. Mm-hmm. It's really hard to do early stage investing when your initial investment is $20, $30 million.
Right. So what is your fund, and are you completed with it? When do you start investing?
It's a $150 million fund.
Okay.
We are investing out of the sort of the primer fund right now, mm-hmm. and we'll be raising the remaining funds over the course of 2008. Okay. But we're already making some initial investments.
So tell us a little bit about what you're looking for with to invest in.
Sure. First, I'll talk about the structure of the partnership, because that will give you some foundation for the kinds of investments that we're looking at. There's two general partners, and we have a team of industry partners. Those industry partners are domain experts. They're historically, or typically, successful entrepreneurs, mm-hmm. who have taken a company from inception through to success, mm-hmm. And then now they don't want to engage full-time in an operating role, but they want to be working with early-stage companies and entrepreneurs. Mm-hmm. So these industry partners, maybe a little bit older, they've got a large network of contacts and large technical domain expertise, and they're already active as board members, as investors, and then sort of mentors to companies.
Right.
So we have 2 GPs and 5 industry partners, and the different sectors that we are already engaged in are networking, enterprise software and services, medical devices, semiconductors, and then obviously software and mobility.
And your industry partners really reflect that expertise in those areas you talked about. So the model, and you were saying, you're saying that this is very different than a lot of angel investors just give a check and
yep.
pretty much leave. But there are a lot of smaller, angel or VC firms that are investing in the range that you're investing in, which is, what is it, $200,000 to $500,000?
First, I'll contrast our partnership focus and structure with a typical venture firm, and then I'll compare it against the angels. In a typical venture firm, you've got maybe 4 or 5 general partners, mm-hmm. and then maybe 1 or 2 venture partners. Mm-hmm. And then over time, the general partners end up being on 8 to 10 boards. So mm-hmm. that really limits the number of new investments, and especially early stage investments they can take. Mm-hmm. Early stage investing is very time consuming. Mm-hmm. You have to help the team with initial customers. You have to help them recruit the initial team members. You help them with business strategy,
Sure.
the product strategy. It's all really time consuming. And then when you're on 10 boards, you don't have that much time beyond the board meeting to engage with these companies.
So you reach out and get the industry partners to come in and fill those in.
We've sort of inverted the partnership model.
Right.
We have a small number of general partners and a large number of these industry partners so that they can spend, on average, a day a week with these companies.
So yeah, that's a great model. I mean, you definitely don't want a board member who's got multiple things going on and no time to spend with you. So talk a little bit about just the investors in your fund. I mean, what we're seeing is that there's investors, there are new investors coming up for this class of venture investing.
The historic venture investors, LPs in venture funds, are university endowments. They're long. When you make an investment in a venture firm, it's a 10-year commitment of capital. So the university endowments are well suited for that because they don't need the capital back right away. They're looking for long-term appreciation. So university endowments, foundations fall in that category, family offices as well. So that's just wealthy families. Additionally, over the last probably 15 or 20 years, you've seen new entrants from pension funds and fund of funds. Okay, so these last two groups brought a lot of dollars into the category. So there's a lot more dollars in venture nowadays than there was 20 years ago. So that's good for the entrepreneur.
Right, it's great for the entrepreneur, but how is it for you in valuations?
It's good for the entrepreneur, but it also makes it harder for them to get the early stage capital. Because with the dollars coming in, they naturally gravitate towards the larger funds. And these larger funds have difficulty making small investments.
So the window of opportunity for you to try to come in there and be the provider of funds for the seed, the seed round. So, so is it competitive in that area, or I mean?
Sure, it's always been competitive. If you look back in the 2000 time period, there were a lot of angels very active because there was sort of lots of nice exits. And then with sort of the crash of the technology bubble, the angels got wiped out and they were abandoned. Now they're coming back in again slowly. Now we often work with angels, but from the company's perspective, the entrepreneur's perspective, we're a good complement and we're a good investor because in addition to being able to make the initial investment, which is small, we can make a quick decision on that. We're there for them on the subsequent rounds. Typically, an angel is only there for a one-time investment, and they're not able to follow in because they don't have the deep pockets. You want a good sizable fund.
Kind of a nice bridge between kind of that seed to A round. You're sort of institution, but sort of not institution.
Now we'll make the initial seed an early stage investment. Then we'll continue it up with the A and B and the C as long as the company does well.
So how Facebook getting a $15 billion valuation, and you have some consumer internet. You're invested in Dogster. So how are you seeing valuations go up in the deals that you're looking at?
We're definitely seeing the valuations go up, and that's good and bad. If the business is progressing and it's able to support that valuation, that's great. Where a company gets in a bit of trouble is when the valuation gets ahead of where they are in the business. Okay, because then they're potentially, if they have to raise money again, it might be at a lower round, and then there'll be some dilution.
But we're not seeing any of that right now. I don't think we're seeing any of those type of things. So
you're still
just a little bit.
You are seeing some of it,
Yeah. Okay.
In the 2003 to 2005 period, 30% of the rounds that were done at down rounds.
In the 2003 to 2005 period,
Now you're seeing a much smaller percentage today, but if things slow down again, you're going to see an increase in that percentage of down rounds.
Okay. So once again, $150 million fund, and it's pretty broad, but you are looking for software services, medical devices.
Correct.
And you specifically, are you looking for anything in particular?
My background is in software. I'm a product person. So prior to being in the venture business, I was a co-founder of 5 software companies. Most recent one getting acquired by Yahoo in 2000, and then since then I've been on the venture side, and I like software and I like products. It's great. Okay, and then if there are any interesting companies out there in the Vader community, they should contact you via Vader if they've got a cool software early stage company. Right, Robert? Absolutely. Okay, well, good luck to you and good luck to Ariva Partners. Thanks very much, man. I've been speaking with Robert Simon. He founded Ariva Partners, which is an early stage venture fund, and I'm Bambi Francisco.